Your whole objective should be to invest in asset allocation, to invest across various asset classes with a view to outperform inflation year after year consistently.
A moment in your career that taught you humility?
Every day, market में इतनी पिटाई होती है, हम humble बन ही जाते हैं. For last 10 calendar years, Nifty has delivered positive return. It has spoiled everyone.
Yes.
They expect that equity market will deliver positive return year after year and it will outperform all other asset classes. Well, that's not possible.
So while investing is an emotional journey, one has to be non-emotional about it to succeed.
Trump को समझना मुश्किल ही नहीं, नामुमकिन है. The whole focus is, are you doing better than your competitor in delivering cheaper, better, faster solution to your customers? As a mutual fund, I have to outperform my peers in performance, in service, winning trust of my investors. Whichever way I do that is innovation, tech, whatever you call. And this is where India has to invest. Many a times I have seen people saying that, why should I listen to anyone's advice? I know everything. Even if you have the knowledge, will you have the time or the inclination to do the right thing? Many a times all of us need a third party to talk about where we are going wrong, where we are going right. When a talented cricketer like Tendulkar, why will he require anyone's advice? And yet he had a coach in Ramakant Achrekar.
In this episode, we talked to Nilesh about his tryst with global uncertainty, the rise of AI, the hype around small cap investing, and of course, the big wave of the informed Indian investor. Nilesh, I have of course known you for over 2 decades, and every time we've heard your speeches, your interviews, you very beautifully blend market data, wisdom, and storytelling, right? In fact, you're one of those investors and wealth creators for such a large part of India. And we've always wondered, in your view, is investing, finding opportunities, an art or a science?
In my opinion, it is a combination of both. For certain basic principles, it's science, and for certain psychology, it's art. So it's neither science nor art, but the beautiful combination of art and science.
Okay, so it's a combination of both. It's not one or the other. Nilesh, let's talk about the life behind all that we see on TV, right? And you started from humble beginnings, went on to very significant roles in leadership from an ICSCI, Franklin, Axis, and now of course Kotak. In the last 2 to 3 decades, how has the understanding of money evolved for you?
As a child, I had seen scarcity of money, so it was always important and valuable. Once you started growing, you realized that you can make money in the market. I started by losing all the money to gain the understanding that money is important. But later on, you just learn the tricks of the trade. And then you realize that making money itself is not giving you satisfaction. You have to share the knowledge with others. Most of the fund managers in India, if they had managed money for their own, they would have made far more money than what they have earned by way of salary. And yet all of them have continued to work because they probably believe that sharing our knowledge and making people wealthier is also equally important. And now you have reached a stage where you want this money to be invested for a good cause. So in some sense, life is a full circle. From scarcity, you aim for, earning. Then you aim for sharing. And finally, you want to share for good things.
Create a legacy.
Absolutely.
Nilesh, becoming a money manager came to you naturally, or were you drawn into it in some ways?
So
you could have been an engineer, a lawyer, but you were a money manager. And I'm, of course, talking 30 years ago when this was not a popular choice of career.
So for me, it was always very clear that I have to be a chartered accountant. That's the course which requires least amount of money and it actually
Okay.
pays when you are
Yeah.
working. And I was lucky to get a chartered accountant who paid me 5 times, 6 times more than what normal article clerk would get.
Yeah.
So it was almost like earning a salary. Now, once I completed my CA, moving into the field of finance was kind of luck. I had gone to join a manufacturing
Oh.
company. They gave me appointment letter and a senior person advised that, look, you should try your luck in the field of finance. I was lucky to get a job in ICICI. I developed my entire understanding of market learning under many of the stalwarts there. And that ecosystem over the decades have continued to work. And I think it's the knowledge and the ecosystem put together and also constant learning which makes you good money manager.
Do you manage your own money?
In a lighter way, no. I get 100 rupee, 40 rupee government takes away. 10 rupee I put it into EPF and NPS. And balance 20 is put into SEBI skin in the game circular. I'm left with 20 rupees, which I dutifully give
Give
to
your
my
wife.
wife.
So you're a
So I
good
have no
husband.
money to manage.
So you're a good husband. Nilesh, you've been extremely vocal about transparency, investor first principles, right? The Indian mutual fund industry is at a cusp of a very, very strong growth that lies ahead of us, right? Uh, where do you think we do well? Where do you think introspection is needed? And what are your thoughts on RIAs?
There was this dialogue in Spider-Man movie, with great power comes great responsibilities. We have done well, but as our size grows, we have to evolve. For example, when I started my career in mutual fund, the definition of insider trading, front running was non-existent. But that would have been a blasphemy today. When we started, valuation was non-existence. And independent valuation was non-existent. Today that could have become blasphemy. So many things which we were doing when we started our industry over a period of time had to evolve and become rules and regulations. Not that what we were doing was wrong.
Yeah.
We were cognizant of our ethical and moral responsibility, but that thing could not have been left at individual discretion. A regulation was needed. And we have seen in India, if you are not regulated industry, especially in finance, by and large, after an initial flurry, you end up into a despair. We have seen so many Ponzi schemes going down, so many cryptos
Yeah.
and lottery kind of things going down. So many NBFCs went down because they were not well
Yeah.
regulated. But all the banks, insurance companies, mutual funds, general insurance companies, pension funds, which are well regulated, by and large, they have delivered better return to the investors. So regulation is very, very critical. Something could be self-regulation, like MFI giving best practices guideline. Something will be what SEBI does in terms of regulation. And we'll have to constantly learn and evolve. At this point of time, the best thing which we have to master is conflict management. When we are managing money for outsiders, we have to ensure that
Yeah.
conflict management is done appropriately. At the end of the day, mutual fund is in the business of managing trust.
Yeah.
You gain it over the years and you can lose it in one day. So you have to really work in a manner people's trust and confidence is retained.
And not take it for granted.
Absolutely.
Yeah. Alicia, you've seen so many market cycles, you've seen political cycles, you've seen growth in India Inc. Looking ahead, I know everybody talks about how we are on a strong footing, but any long cycle is made up of many smaller or micro cycles, right? When you look ahead, where do you see the growth of India lies, and what are the challenges that you foresee that could potentially play catch up?
So growth of India lies in the Triveni Sangam. One, the talent. We have some incredible talent. We need to retain them so that when they work, benefit doesn't go outside, but it remains within India. We need to nurture them, we need to protect them. And when I say talent, it does not necessarily mean people passing out from higher educational
Yeah.
institute. It could be a person on the ground also. How do we encourage our talent, nurture our talent, and protect them will determine success of India. Talent also requires infrastructure. We have been building infrastructure on a scale, but the speed can be improved. China built a hospital in Wuhan during COVID time in about 10 days, 1,000-bed
Yeah.
hospital in 10 days. We can't even decide how to name a hospital in 10 days. How do we build infrastructure with speed on scale like China? And finally, talent and infrastructure requires capital. We do a lot of savings, but that savings allocation is very, very poor. People trade in cryptos to lose money, people trade in NFTs to lose money, people invest in assured return schemes to lose money, people buy lottery to lose money, people speculate in FNO to lose money. Collectively, there is quick money addiction in India. Everyone can recognize drug menace around them.
Yeah.
But this quick money addiction, not many people can recognize. And by the time they realize it is too late, they have destroyed their
Yeah.
financial security. So we have to ensure that this misallocation of saving stops, this quick money addiction goes
Yeah.
away, and this capital is available to our entrepreneur. Some entrepreneur will succeed, some will fail, but this Triveni Sangam of talent, capital, and infrastructure will create India's growth. Where do we go wrong? Where can we go wrong? Our risk is risk of self-goal. For example, Tata's wanted to set up an automobile plant. They went to Singur, worked there for years, nothing worked out. Finally, they had to
Left.
come out. Today, where is Singur? No growth, no jobs, no employment, a bit of a despair. Tata's moved to Sanand. It was a similar area like Singur
Single.
in terms of farmland. But today it has become automobile hub. Apart from Tata Maruti factories there, they are exporting, there's jobs, there's growth, there's development. Are there challenges in Sanand? Undoubtedly, urban infrastructure
Yeah.
could have been better, pollution could be controlled. But those are the prices to be paid for the growth. And eventually we can correct it. We cannot go back to Singur model to, you know, create
Undo. Yeah.
to score a self goal. Our model has to be Sanand model, and within Sanand model, whatever corrections are necessary, we have to do.
Right. Nilesh, you alluded to how China had the ability to create infrastructure. Of course, there is no other Alibaba in the world, right? But what I've also heard a lot of managers say that in the last decade, while Chinese businesses did exceptionally well and grew from strength to strength, equity investors did not make money.
Yes.
I want to just compare that to the India today because the path ahead is in some ways the path that China undertook maybe 2 decades ago. What happens to equity investors there? Do you feel like if India grows, equity investors will also be rewarded, or could we go down the China way where businesses make money but investors may not?
So, what many people don't recognize, China is a very bad allocator of capital.
Okay.
The earnings growth of CSI 300 index for last 10 years is just about 10% in renminbi terms. Companies have made money, undoubtedly, companies have grown, undoubtedly, but without margin. They have kept on diluting their capital and hence return on equity is poor, earnings growth is even more
Yeah.
poor. Compared to them, in India, ROE focus is far higher, our capital output ratio
Allocation.
continues to be far superior to China. China is growing because it has large amount of capital, a huge current account surplus. We are growing because we use that capital efficiently. And our earnings growth in the same period was 180% in rupee terms. Now, do remember 10% renminbi terms, 180% rupee terms, but more or less we are way ahead. and our ROEs are better. In fact, what I will recommend, and partly we as an investor community is responsible for it, we have always expected our investee companies to deliver higher earnings growth rather than sustainable earnings growth.
Okay.
They must invest in R&D. They must invest in innovation. Uh, Even if it means compromising a part of earnings growth, so be it. Our excessive focus on ROE and earnings growth is probably impacting our long-term sustainable growth. And companies which are innovating, they are getting rewarded far more than companies which one believes are stagnating. Today, Zomato's market cap is higher than many established
Yes.
companies. It just shows that market is willing to reward
Pay the premium.
innovation.
Talking about innovation, which goes hand in hand with, I think, the most popularly Googled word is AI. What is the role of AI in the India growth story, and also maybe at the level of making investments? And I don't know how to word this correctly, but what I want to understand from you is, how do we use this to grow, as opposed to this being a reason to degrowth or loss of jobs? Because you said capital and infrastructure and employment are the key triggers for India's growth story.
So on the AI side, we have seen two models. Western model, which powers in billions of hundreds of billions dollar, or Chinese model, which at least on paper looks like powering far less capital. I think we have probably missed the bus of creating LLMs. Those are already present and working well. We must focus on building on those highways buses in which commuters will be willing to ride. And let those commuters pay a fare for the bus and will pay toll for using the highway. I'll still be able to make money. What do I mean by this? We have to create models on top of these highways which are efficient, faster, and cheaper. And companies and individuals will pay for those models because they'll be the best. Today, without data, AI is useless. Companies will need Indian IT companies to arrange their data, to leverage their data. Once data is set, you will require cybersecurity. Indian IT services company should be the first choice. Finally, we have to compete with someone else. We should leverage AI in a manner that we are able to provide better, cheaper, faster solution compared to the other people. By combination of this kind of things, where we are creating better, cheaper, faster solution than our peers, we can still continue to be leveraging AI for our benefit.
Recently a fund manager mentioned to me that the big play is tech, but tech doesn't necessarily mean IT, right? Because what he also told me, he said, finance individuals think linear, engineers think non-linear, and growth comes from non-linear play, right? So if you're investing in a bank stock, or you're buying into an AMC, or you're buying into a consumption name, it all eventually comes down to tech. Do you think that's true? Do you resonate with that statement?
So everything is true in its context. Now, has Apple's market cap came because of engineers or CFO? Jury
Yeah.
is not out.
Yeah.
The CFO organized buybacks, and that probably
That too,
resulted to
yeah. The
far
rally,
better
yeah.
creation of market cap than all the engineers put together. So again, the whole focus is, are you doing better than your
Peers.
competitor in delivering cheaper, better, faster solution to your customers? As a mutual fund, I have to outperform my peers in performance. I have to outperform my peers in service. I have to
Everything.
outperform my peers in winning trust of my
Yeah.
investors. Whichever way I do that is innovation, tech, whatever
Whatever it
you
takes.
call. And this is where India has to invest. We haven't invested in technology and innovation for fear of failure as much as we should have. There are a few bright spots like our UPI, Aadhaar, they are world class. But we need same mindset in many other things. For example, even simple things like machine tools, hand tools. We are a large importer of such items rather than exporter. Uh, can we create a mindset where there is import substitution and there is export focus? If we can achieve this, that means we'll have to make products which other people want, and it should be at a price which other people can afford. So we really need to invest in R&D, innovation, tech, whichever way you call it. Will we be able to do everything? Answer is no. But at least few things we should be global leader.
Talking about global leader, we can't not talk about Trump and the tariff conversations that are taking over every dinner table discussions, right? Where do you think this is going, and what is the impact of this going to be on investors and on India Inc.? Should we be worried? Because in the near term, this looks like it's going to be painful.
So one, ट्रम्प को समझना मुश्किल ही नहीं,
ये नामुमकिन
नामुमकिन
है.
है. It's very difficult to predict President Trump. The market in its collective wisdom is assuming that this tariff will be a short-term measure. The longer-term interests of India and US are aligned. And by levying tariffs which are completely unjust, for example, we are not the largest buyer of energy from Russia. Neither we do the largest business with Russia. This 25% additional tariff is completely unjust. The second thing, they don't recognize that there are 300,000 Indian students studying in US. They contribute substantial portion. There are 1.7 million travelers from India visiting US.
Yeah.
If they give more visa, there will be more people visiting. We have allowed their Starbucks and McDonald's and KFC and everything to operate in India. They don't get that kind of luxury in many parts of the world. We don't copy their IPRs like it happens in some other parts of the world. And most importantly, their big tech is big because they have free entry in India. Now, with all this kind of relationship, targeting India with tariff is completely unjust and unreasonable, and which is why market in its collective wisdom is assuming that this will be temporary. Sane voices will prevail on both the sides. My feeling is that if this tariffs doesn't remain temporary, then there will be pain in sectors like textiles, aquaculture, gem and jewelry. We'll have to find alternate buyers, which will take time. And we'll have to provide some temporary relief to exporters in sectors impacted by US tariff. Overall, could it be 0.5% to 1% of GDP, including multiplier effect? Answer is yes. To negate that, we'll have to stimulate our domestic economy, and GST cut was first step in that direction. Will require more measures if these tariffs don't remain temporary.
Right, talking about the markets, and you alluded to GST as well, all those measures taken have not really enhanced or sort of, boosted the markets in any big way, right? We saw earnings as well that was slightly disappointing. I know valuations look far better today than they did maybe a quarter out. But the fact remains, some may argue that this is a time correction that we're going through. Given the global uncertainty, and there's always uncertainty, right? This time it's Trump, a few years ago it was COVID, then there was the war, then there's crude. How does an investor plan his journey? And this is again somebody from an AMC mentioned to me that the problem is not SIPs, those folio numbers keep getting added, but ad hoc pausing is what could become a problem. So, what do you make of the market at its current juncture, and what should investors be doing?
So one, for last 10 calendar years, Nifty has delivered positive return. It has spoiled everyone.
Yes.
They expect that equity market will deliver positive return year after year, and it will outperform all other asset classes. Well, that's not possible.
Yeah.
Equity markets are bound to have
Volatile.
volatility and some period of negative return. So this is a very, very healthy correction which is going on. There is selling by FPIs. There is concern on valuation. The earnings growth has come down from low double digit to high single digit, and hence there is a need for consolidation. I think as an investor, you have to take in your stride periods of volatility and negative return, especially when you had a home run for
Yeah.
10 years. Number two, you are investing for longer term. Equity market returns are not linear return. Sometimes they give 5 years return in fifth year, sometimes they give 5 years return in first year. Now, with the benefit of hindsight, we can figure out, oh, we should have invested
Yeah.
here, invested here, redeemed there. We haven't seen anyone doing that in real life. So my only advice to investors has been, please follow the Dharma of Asset allocation. Divide your portfolio between debt, equity, real estate, and precious metal, some foreign assets also if possible, and aim to outperform inflation year after year consistently. If you do that, you will do well.
I'm glad you bring that up because that's exactly my next question. So, as advisors to a lot of the ultra HNIs in the country, our focus is always on portfolio returns. It's not at a product or a line item wise, right? And we tell our clients this that returns are a function of asset allocation, very rarely because of a given product. In that context, how is it fair for me to say that the role of maybe fixed income, InvITs, REITs, gold, silver, global allocation is going to be far more to generate positive returns or to beat the benchmark in some ways over this next cycle?
Undoubtedly, we believe silver and gold
Yes.
deserves allocation in a client's portfolio. And if central bank continues to buy them, gold, they have been traditional buyer for decades. Silver, Saudi Arabian central bank seems to have made a start. If others copy, we could see gold and silver delivering far better returns. So they must be part of your portfolio. REIT InvIT again. Today, many people have their second generation, which is either abroad or not as much into the business. If you leave them with the real estate portfolio, they are going to curse you at some
Yeah.
date. Give them REIT InvIT, it will deliver similar risk
Returns.
return. Fixed income again has been neglected, but it anchors your portfolio. And today within fixed income, you are performing credit
Credit.
AIF, which can outperform inflation, albeit with some extra risk. So your whole objective should be to invest in asset allocation, to invest across various asset classes with a view to outperform inflation year after year consistently.
Would you recommend investors then to rebalance their portfolios on basis of strategic goals or market cycles?
Why not both? In an expensive market, no matter what your strategic goal, you will be underweight that asset. In a cheap market, no matter what your strategic goal, you will be overweight that asset. But both underweight and overweight requires anchoring. And that anchoring is based on your strategic asset allocation. So my recommendation is that have a 3 by 3 box in your mind for every asset class. I'm underweight, neutral, or overweight based on my goals, and markets are cheap, fair, or expensive based on valuation. In a cheap market, I should be overweight. In an expensive market, I should be underweight. In a fair market, I should be neutral. If they apply this 3 by 3 box, they will recognize that in most of the cheap market, they became underweight because they didn't buy in the fall. They waited for the perfect bottom, which never came, or which came and they missed. And in most expensive market, they are overweight because their portfolio appreciated and they failed to book the profit.
So you mentioned that they've either missed the fall or couldn't find the right opportunity or were attempting to time the market. Now, this may be easier for you than most of us. Do you then say that while there is merit in catching the bottom, it's actually easier said than done, and hence just staggering investments over a medium term is probably the best way to navigate the market?
So even for us, it's not
Easy.
easy to catch the top and the bottom. We run balance advantage fund where we
Yeah.
divide between debt and equity based on valuation. In March 20, our balance advantage was 75% equity. Ideally, I should have been 80. In Jan 20, I was at 38% equity. I should have been 20.
Jan this year?
Jan 20,
2020.
COVID time.
Yeah.
Now, 20 and 80, I was directionally
Yeah.
right. When I should be 20, I was not at 60, I was at 38. When I should be 80, I was at 75, not at 45. So directionally, you can capture these moves, but to time it to the perfection, you need
And
to
to
be God.
size the bet is also such a
Absolutely.
challenge, right? So just I'll talk to you about, of course, conflict-free advice, because that is again something a lot of investors are waking up to. But we'll talk about that in a minute. We work with a lot of ultra HNIs and family offices, and so do you. You want to tell me, in your experience, how do ultra HNIs invest, which is different from what the wealth or retail investors do? And what I really want to understand is individuals and families that have created significant wealth, how do they view this journey versus people who still have near-term goals to fulfill and hence investing?
I'll break it up in successful investors
That's
versus
actually
failed
easier, yeah.
investors. Because many retails are successful and many ultra HNI are a
Failed, yeah.
failure. One particular trait of a failed or not so successful investing is they have very wrong expectations from their manager. In a rising market, they want to have momentum.
Yeah.
In a falling market, they want value. They want to capture the top and bottom. They prefer short-term gain over long-term pain rather than short-term pain for long-term gain. So they are always chasing past performance rather than, trying to forecast future, even at the cost of going wrong. The successful investors knows they can't time the market. They are willing to bet based on certain call. They know some will go wrong, but whichever goes right is good enough to give them the margin of safety. So if again I go back to that 3x3 box, successful investors don't mind short-term pain in an expensive market where they keep on booking profit and eventually become underweight from neutral weight. The not so successful investor is one which is chasing momentum and seeing his return actually buys in a rising market, expensive market, and becomes overweight. And eventually that results into their downfall.
Nilesh, but not all investors would have the know-how or the ability to rebalance. And from what you're saying, I do understand that that's actually very important for significant wealth creation, right? Do you then sort of marry that to saying that you need a conflict-free advisor who's aligned to you and who's making changes or recommending changes, not because they're trying to churn the portfolio, only because it's good for you, and that's where that 1 or 2% constant compounding alpha is going to be generated?
So many a times I have seen people saying that why should I listen to anyone's advice? I know everything. Even if you have the knowledge, will you have the time or the inclination to do the right thing? Many a times all of us need a third party to talk about where we are going wrong, where we are going right. I mean, a talented cricketer like Tendulkar, why will he require anyone's advice? And yet he had a coach in Ramakant Achrekar. Similarly, we hear a bowler or a batsman going through a lean patch and then they go back to a senior or an expert to get the correction. Someone will say, you change this, you do that, and those tinkering starts working so well. They give just nudges and it works. So if talented cricketers require coach, who are we as an ordinary investor to say that I don't require a coach? It's not that coach is more knowledgeable. It's just that they are able to see without emotion.
Objectively.
Investment is all about rationality and all of us are emotional. So you require someone who can bring that non-emotion based decision making, who can nudge you, this is the right thing to do, this is not the right thing to do. Even if you follow 50, 60, 70% advice, that's more than sufficient.
So while investing is an emotional journey, one has to be non-emotional about it to succeed.
Absolutely.
And I'm going to ask you for advice. So most of our clients are in that 25, 50 crore financial assets segment, right? For families who have that sort of basket with financial assets, what advice would you give them in order to diversify their portfolio? And I want you to talk about a little bit of the growth pool allocation as well, which is unlisted. Because a lot of the new age investors, entrepreneurs who've had success in the unlisted universe are enamored by that space. I often say that this is delayed gratification and it comes with illiquidity. How important is it for an investor to have their eggs in all these baskets, listed, unlisted, and any other diversifiers that you think are important?
So, first understand your risk profile and then marry it with your investment objective. By definition, you can go into unlisted space only if you can suffer illiquidity and your risk taking ability is high. Many times people want that one successful investment which goes up many
Yeah.
times. But please remember, many of the venture capitalists have spread their investment across so many companies and then one of them becomes successful. Now, you also have to follow the same strategy. So, you can invest depending upon how much risk you are willing to take and how much illiquidity you can suffer. Each family is unique. Instead of seeing how others have become successful, you have to see what is your risk profile and in what boundaries you want to play. Copying someone else's play is a surefire way to lose money.
So, would you say then it's probably a cleaner and better way to invest in the funds as opposed to identifying companies and investing in them? The only reason I ask you this is because if you invest in a fund of fund structure, which is multiple private equity VC managers, that gives you a way to diversify the managers and also diversified industries and stages of investing. Could that be a better way,
So,
you think?
whenever you buy a fund, you are basically riding in a public transport, a bus.
Yeah.
It will have its own stops, it will follow, it will move slowly, but it will take you to destination if you sit in it.
Stay the course.
If you can hail a cab, well, you can reach faster to
Yeah.
your destination, but you should know how to hail the cab,
Or you should know your destination in
or
some
you
of
should know
these
your
cases.
destination.
Right. Also, that's the unlisted play, but you've seen, and so have we, everything that's happened in this, again, excitement around pre-IPO, unlisted stocks that are going to list next year, SME IPOs. How would you evaluate this space as an investor, as a personal investor? Because all of this can get in between the discipline that the industry, the regulators constantly keep reiterating about. Should you fall for it? Should you not? Because it is exciting.
So, one, you should never bite more than what you can chew. Number two, all these are very exciting things to hear: pre IPO, SME IPO, small cap, micro cap, mini cap. But please don't invest without research. If you can't do appropriate research, you are unlikely to benefit out of that investments because it will taste your patience at some point of time, and without research, you will end up taking a wrong decision. Third, there's no harm in experimenting. So if you have someone who knows a lot about SME IPOs, go and invest small money, see how the experience goes, and then you can build upon it. If you trust a friend or
Yeah.
a family, and they are coming out with pre-IPO and they are kind enough to give you some offer,
Do
consider
it.
it. Take a small part, see how it goes. Uh, many years ago, when I was fund manager, uh, we were always under that impression that we should invest, which will become new HDFC Bank. They are very successful. Let's go and find out another bank
Yeah.
who is like HDFC Bank. And one day my boss said that, look, every third or fourth year in those years, HDFC Bank was creating another HDFC Bank because they were doubling.
Yeah.
I said, why are you going in search of another HDFC
When
Bank?
we
Just
have
buy
one.
this.
Yeah.
So many a times you have successes in your portfolio, but you don't keep on adding on it.
That's a good point. Tried and tested. Right. Just couple of more questions, and I want to talk to you about what a lot of wealth advisors are talking about. Right now, suddenly everyone thinks that we've relatively underperformed most of our peers year to date. And now the noise is getting louder about how you want to play emerging markets, you want to buy into China, you want to look at Brazil, Argentina, US may be looking like a tough journey ahead, you want to buy Germany. Now, all of this is correct philosophically. But for an investor sitting in India, north is different from south of our country. How does one regionally diversify a portfolio? And do you feel like there is merit for it? And if there is merit, should one tactically say emerging market will look good for the next 6 months and 6 months later maybe Germany will look better? How do you play that game?
So
Should
my
you participate in that game,
so
most
my reco
importantly?
is very simple. It's very, very difficult to track global markets. Today, sitting in India, I have no idea what happened in Nepal.
Correct.
I may end up taking a wrong decision based on headlines as I don't have any presence there. The same thing will apply in other parts of the world. It's far better to invest in a diversified fund, let's say global emerging market fund or a global technology stroke innovation fund or large market like US and China, which are continent by itself. So in your global portfolio, either it's global emerging market or global sector fund or US or China. Other than this four category, no point in going to individual category. Someday Argentina will do
Yeah.
well, someday Brazil will do well, someday Germany will do well. But we are most likely to learn about that in hindsight rather than in foresight.
And the product availability in India is obviously limited when it comes to some of these structures.
Yes.
Do you then think making allocations to world markets is better done through LRS?
You can use LRS to go and buy funds over there. You can probably go and buy some of the stocks also if you want to. But do take advantage of LRS to build an international portfolio.
Right. Just one quick question in terms of what is the role of conflict free advisors who are working with ultra HNI families, which are all going through a cusp of growth in some ways, right? Wealth is transitioning from one generation to other. There's quite a bit of talk about creating a family constitution, governance, global diversification, betting on the next entrepreneur. What do you think the role is of an advisor when the ask and objectives are so scattered?
So my feeling is that like you have a family doctor who takes care of health of entire family, you need a registered investment advisor to take care of financial wealth of the entire family. In most cases, it is beating inflation, preserving capital, growing capital. But in many cases, it will be also transition. Which structure will be appropriate? In many cases, it will be equal or equitable distribution, if not equal distribution. How do you ensure that the kids which are running business are also fair to the
Yeah,
kids who are just
it's
an
passive.
investor? Uh, it will also be building legacy. Many of the families just don't want wealth for the sake of wealth. They want to do something good for the
Yeah,
society. So my feeling is that registered investment advisor is not just about generating return on the portfolio. It's covering many
yeah.
other aspects which are very important, but people don't recognize it. I still know a gentleman who was a lawyer, and when he died, he had some 300 mutual fund schemes in
Oh,
his portfolio. And his wife had a tough time. I have seen family where husband suddenly passed away, and wife had no idea where the husband had invested. To bring everything together
yeah.
was a Herculean task. Fortunately, you know, I was part of a private bank in those days, so I could provide those
Help.
services. Until today, those families have remained well-wisher.
Yeah.
But my whole point is that why, go through this whole turbulence? Might as well start
Prepare.
preparing for it in advance by hiring an investment advisor, and the charges are not that high. The
No.
cost benefit analysis does recommend or suggest that you need to have a family advisor just like a family
Yeah.
doctor.
I mean, I often say this, right? Investments is only one part of somebody's wealth journey. There are so many different moving parts
Yes.
to that journey, right? Well, let's move on to a few quick takes then. One book that you would recommend for each generation, Gen X, Millennials, and Gen Z.
Just read everything what is available. Don't focus on one book. Read. Make reading 2-3 hours a day.
The most common investing mistake that every investor makes, and I'm going to ask you, what was that one mistake you made? That
This
you
time it is different. History
delusional.
keeps on repeating because we don't learn from history.
Yeah. A moment in your career that taught you humility?
Every day market में इतनी पिटाई होती है हम humble बन ही जाते हैं. But this is one particular time where I have gone wrong in both the markets. I expected rates to come down, yields have
Yeah,
gone up. I expected equity markets to correct. They haven't corrected.
corrected.
Like after 30 years in market, you have gone wrong on both the sides. With what face I can tell my
Team,
subordinates
yeah,
that do a good job? They'll
yeah,
say, sir, you should do a good job.
yeah. Do you think the markets are still going to correct?
It's always difficult to predict short-term movement, but I know for sure that in the long-term market will go up.
Easy answer. Also, your best in I don't know personal investment advice. I mean,
So
I'd say just advice. Why does it have to be investment? There's so much more to you than just investments.
different stage, different view. My views 30 years back were different. Today it is different. I think best investment for you is your relationship. I'm right now going through a slightly difficult phase because of a medical situation in family. And I realize it is the relationship which matters.
How important is work-life balance?
I am from a generation which says that work is life.
So, do you spend enough time at home with your family, your kids, your wife?
I haven't. I regret it. But if I had tried to spend more time with them, maybe I wouldn't have reached
Been where
where I
you
am.
are.
But whatever time you spend with family, it should be quality time, undivided. And most importantly, they should always feel that when there is a need,
You're there.
I'm there.
Are your children going to follow in your footsteps?
Oh, both my kids said that, Papa, the
How old are
work.
they?
So both are in their 20s. And both of them have said, like, Papa, the work you do, does it benefit society?
Wow.
And I said, yeah, I make people wealthy.
And myself.
There's nothing better than that.
Yeah.
But my younger daughter has gone into field of medicine, and
Fantastic.
elder daughter is going into field of sustainability
Wow.
management. So both of them have chosen their field. And as a parent,
Fantastic.
you just want to back their
Yeah. And
aspiration.
these are great. I mean, it's so much about giving back and building the legacy that you talked about, right?
Absolutely.
Well, thank you very much, Nilesh. There's always so much to learn from you every time we see you. Thank you.
Thank you.